Time now to turn our attention to the personal finance segment. Harsh Roongta of apnapaisa.com is our guest for the day. And Harsh, the first question is, we understand that investors often don't calculate returns on the real value of money. How is a percentage return different from the absolute return, and how can investors calculate it?
Well, I think, we can just use an example. Say if a 3 lakh rupees invested today turns into 90 lakhs 30 years from now. Now, on the face of it, most investors would calculate that you made 87 lakhs on a paltry investment of 3 lakhs and that it is an excellent investment. The key point is, if you actually calculate the percentage return, which is what you will need to do if you want to compare it with anything, compare it with inflation, compare it with any other form of investment, we will realize that the return is only 12%. So in any long-term investment, it's not the absolute amount of money that you make, but the percentage that is important. Most frequent example are long-term investment products. Things like you invest 1 lakh for 5 years, wait for another 15 years, then after 20 years, every year you'll get 1 lakh back for 20 years. That's a return of 20 lakhs on an investment of 5 lakhs. Again, looks great, but when you do the calculation, that is just about 5.5%.
Harsh, when you're calculating this 12% in the previous example of 3 lakhs becoming 90 lakhs,
right,
or the current example of 5 lakhs becoming 20 lakhs,
right,
are you only taking the interest rate projection, or are you adjusting it to inflation?
No, I've just taken what is presented to say to a client, that this is what you will get.
Actually, adjusted for inflation, it is even less, you're saying?
It's 5%. So if you take the second example, it's 5%. When inflation is running at 8%, this is a negative investment, essentially.
Okay, and in the previous example of 12, was that only an interest rate calculation, or was it adjusted to inflation?
No, it is an interest rate calculation, but unless you do the interest rate calculation, you cannot really find out whether it beats inflation or not.
Okay, well, that's very useful advice, Harsh. 2 points emanating from what Harsh is saying. First of all, when you are presented with these massive amounts, do a simple, simple interest calculation or a compound interest calculation. Hardly difficult calculators available for compound interest calculations. The interest rate will not be as impressive, and secondly, you will have to adjust it to inflation. Will 3 lakhs buy what it is buying today 30 years from now? Chances are it will buy peanuts compared to what it buys today. So both those adjustments important to make. We are taking a break on that note. We are having a lot of viewers with similar questions for Harsh. Back in a minute. Welcome back. Just a quick look at the markets. Not moved much at the index level, but you have to watch out for all the important momentum boys. Watch out for the power stocks, watch out for the realty stocks, watch out for the banks, the state-owned banks. They have had a huge and heavy contract, and therefore some long unwinding cannot be ruled out. Bears watching all those stocks. But now we are watching for what your money earns you. We just had Harsh telling you that fancy projects or investment ideas which tell you, give me 1,000 every month for the first 5 years, and 20 years from now I'll give you 1 lakh every year. Those kinds of projects, when you actually calculate the interest, don't amount to a great deal, and if you count inflation as well, will amount to even less. Questions on those and other issues. Gaganjit Khurana from Gurgaon joins us. Gaganjit, go ahead. What is your question?
Yeah. Hi Lata, how are you?
Yeah.
My name is Gaganjit Khurana. I am 35 years old and I am an architect currently residing in Gurgaon. I wanted to plan for my 6-month-old daughter's education. Basically, I met an insurance company agent and he informed me of a scheme where I would have to pay about 30,000 per month, and I would get 16 lakhs over a period of 20 years. This would be in 3 payouts. Basically, there will be 2 lakhs after 16 years, 2 lakhs after 18 years, and 12 lakhs after 20 years. I'm actually now very confused. My question is it better to opt for an investment plan that is tailor-made for educational purposes but offers low returns, or to go with a traditional portfolio of, equity, gold, and mutual funds?
Go ahead. Classic question, classic dilemma. Harsh, what is your reply?
So Gaganjit, I'm just curious, why would you even weigh the two options? What is making you weigh the option where you would accept a lower return? In return for what?
See, this also carries some insurance cover actually. So if something was supposed to happen to me, then I'll get some 200%. Actually, there were a lot of things he told me.
Right.
There was some rider, there was some
Right.
booster payouts, which is
Right.
confusing actually. So, and I just thought that since it's from a professional fund manager or something, it's just, I mean, they'll know better than me. So,
No,
but,
so I think investing with mutual funds and with
This is an insurance.
professional fund managers.
Harsh, this is an insurance, not
I
a mutual
understood.
fund. Yeah.
I have understood. So my point only is that there is no earthly reason for you to accept lower returns for just for getting a tailor-made plan. Insurance is extremely important. To that much extent, you can't argue. Obviously, if something were to happen to you, you would want to ensure that your 6-month-old child, her educational plans are not at all compromised. But for that, buying a term insurance is the easiest and the cheapest way out. Once you have that out of the way, there is no earthly reason for you to accept lower returns. And since you've given such a long horizon, I mean, you can choose mutual funds, you can choose PPF if your return, if your risk perception is low, if you don't really want to take risk. And in all cases, you will find that whatever plan that has been told to you will hardly return you 5-6%, and even that is not guaranteed, right? So, I mean, same way in others. Of course, if you invest in a mutual fund, your return is not guaranteed, but then the return that you get would be much higher. If you don't really want to take risks, then maybe you can look at PPF. The point is, you do the calculation for this return, whatever has been told to you, and you will find that it is 5-6%, which is not even beating inflation. So I think you have to get a investment instrument that beats inflation. Incidentally, I think in the amount itself, this 16 lakhs that you are planning for might look okay today, but 18 years from now, when your daughter really needs it, and if inflation is running at 8%, you probably need 4 times that amount for it to be equivalent to 16 lakhs today. So please adjust for both. Please adjust your corpus amount for inflation and make sure that whatever investment that you do gives you a return much better than inflation.
Point taken, Harsh. That's very useful advice. So Gaganjit, take away the insurance element with a term plan, and then you may find that mixed plans like these don't really give you much except maybe 5 or 6%, as Harsh was saying. It would be much better to go with the traditional mixture of maybe mutual fund, gold, and the other things that you had in mind. An investment advisor would be most useful. To the rest of you viewers, please tune in tomorrow as well. We are similarly handling questions that bedevil you and me and everyone. Hemant Rastagi will take us through the importance of reviewing your portfolio at regular intervals, how regularly it must be done, and which is the best way to review your portfolio.
But I think we've got the European market opening as well. So quickly, let's focus on that. It's opened up in the green, so it's got a gain of about 0.5% to 0.7%. So it's an up move after the losses that we've seen in the European markets over the last 2 days, particularly yesterday, where the losses were very sharp. Over 2.5% got lost. And also because today Asia started off trade in the green with reasonable amount of strength. Actually, China is up over 2%. So on the back of these two factors, it's in the green for the European markets, but it could be a volatile session because with respect to the Spanish market, they will be presenting the 2013 budget reform today. They're hoping to cut the budget deficit as well. And in context of that, you are seeing violent protests in Spain as well as in Greece for 2 consecutive days now. So it could turn out to be a bit of a volatile session as the news flow continues to trickle in. That's the Spanish market opening. Looks like a marginal bit of bounce over there, not too much, up about 0.5%. Quickly run you through what the bond yields are pointing to, because remember yesterday the 10-year Spanish bond yield went above that 6% mark. It closed at that 6.07 mark, and in today's trade it spiked up even further. So as we speak, 6.12 on the 10-year Spanish bond yield, and Italy as well has moved higher. So the treasury markets are not looking great over there, and euro as well lastly should come up for you on your screen just as we slip into a break. But on the whole, it appears that Europe has seen a marginal bit of bounce back, but a lot of news flow to track, so we will get chatting about it with Adrian Foster of Rabobank on the other side.